So I'd like to spend a few moments talking to you about the accounting and tax aspects to consider when you're preparing for selling your business. This should help to maximise the value that you get out of the business and also help the whole process to go as smoothly as possible, which should help the speed at which the transaction completes and minimise the costs for all parties. I'm going to move on and talk a little bit about the way in which the seller would receive the consideration, because there are different tax implications, and so this is important to think about during the negotiation stage with the buyer and not leave things to the last minute, because once you've agreed heads, it's very difficult to change the structure. So the most common element of a sale is cash proceeds. So you receive the cash, and as you would expect, that's going to be taxed at the date of completion. When I say taxed at the date, that's the tax point. So it will fall into the tax year where completion of the sale occurs. Now, cash is taxable even if it's deferred. So you would expect to be taxed on it if you've received the money, but if it's deferred, let's say the buyer says we'll pay you half now and half in a year, and the only condition is that you need to have stayed with the business for that 12-month period following completion, the payment in a year's time is still taxed as though it was received at the date of completion. Now, if for some reason you didn't receive it because the buyer can't pay and they default, then you would be able to claim back the tax that you've paid up front. Another common form is to receive some of the proceeds in the form of shares in the purchaser or in another vehicle. The default position is that the proceeds or the value that you're receiving in the form of shares is deferred until those shares are later sold. However, you do have the option to tax those shares up front if you want to, which may sound counterintuitive, but actually it could be that you've got some relief, so you could apply the business asset disposal relief or some other reliefs that you want to apply, so you need to tax the shares up front. That's an option available to you. Loan notes is another form of deferred consideration. It's a more formal structure of deferred cash where you actually have a loan note instrument which can be secured or unsecured. That can be taxed up front, or it can be taxed on receipt. With loan notes, it's quite important because it's quasi-cash. It's important to get a tax clearance from HMRC in advance of the transaction to make sure that you know for certain how the loan notes are going to be taxed. What you don't want is to think that they're going to be subject to capital gains tax and be deferred, and then you find out it's actually, not only is it all taxed up front, but it's taxed as though it was a dividend. So get the tax clearance would be my advice there. Similarly, earn-outs can be very complicated. Earn-outs are where your future proceeds are dependent on some financial metric of the business. That could be profitability, it could be net assets, it could be sales, it could be an element of growth, it can be really almost anything. But because they are so flexible, there are different ways in which it can be taxed. So the advice there is just to be aware of that. If the buyer suggests they want an element of earn-out, make sure you understand how it's structured and how it will be taxed. And again, get a tax clearance.